What exactly then do you make of this? Is this a softening of language, or are we still focused on that so-called terminal rate, or where the Fed ends up its campaign of rate hikes?
Good morning, Dom. Great to see you. And there really wasn't a tremendous amount of new news there. I think after we got the CPI report last week, we all knew that 50 basis points was likely going to be what we saw. 75, I think, was essentially off the table. So we didn't really learn a tremendous amount there. If anything, I think it's a reminder that the market has just been so preoccupied on this pivot or this slowdown in rate hikes, but we've lost sight of the fact that the terminal rate itself, I don't think has changed. We're still looking at 5 or 5.25%. And in that in and of itself is going to be challenging for some of the higher duration parts of the market that rallied really hard off of the bottom. So when I've been talking to clients, really the main message is don't chase the market higher. Let the market come to you. There's certain sectors that I think continue to look attractive that we've been leaning into this year, which includes healthcare, energy, and really overall maintaining what I like to call a core defensive bias. So leaning into higher quality. So higher free cash flow, ROE, stability, and earnings growth. Those are the types of companies that you still want to own going forward. I just don't think the playbook has changed. And a lot of the Fed speak just reemphasizes that.
Okay, so Matt, what we're doing right now, I don't know if you can see it, but what we're showing viewers right now is a series of charts for the Dow, the S&P 500, and NASDAQ. Now, if you look at the Dow chart, we are not that far away from the highs that we saw over the course of the past year. It is a very different story when it comes to the S&P 500 and certainly the NASDAQ composite. So you mentioned this idea that you can let the market come to you, but which chart are you supposed to look at? Because right now you could get a sense of FOMO, right? Fear of missing out if you looked at the Dow chart. But the NASDAQ and S&P still say, hey, you know what? I didn't really miss out on that much. Things are still pretty bearish right now, but by the way things look.
Right, and a lot of that, Dom, comes down to just how these indices are actually constructed. I think the NASDAQ overall, it's just too early to be moving into technology. There's obviously going to be very idiosyncratic opportunities that look attractive at current valuations and growth prospects. But the Dow, I think, just reemphasizes the fact that those tend to be higher quality companies that are outperforming in the current market. You do have more healthcare companies in there. You've got some aerospace and defense that has been working well. So, and when you look at the totality of those charts, I think the main takeaway to me is that while the stock market itself, the indices are telling us one story, the market of stocks, the fact that there's increased breadth across the entire stock market and what's working, that's more of a positive, I think, longer term. So I think you can take away some optimism from that, but still, I think the main message is that the indices overall are going to remain challenged, and that's why you don't want to be chasing the market higher. And the volatility we've seen over the past, I'll call it weeks, really is just a reminder that there's no need to do that because the market will give you the opportunity if you're looking to redeploy some cash.